think we might be going live in a second.
Okay,
Just
wait.
preparing to live stream.
Kira?
Pardon?
Clara can't hear anything. Oh my god.
Wait, try taking your headphones out, Clara.
There we go.
Oh my god, guys. Oh my god, I can see the YouTube thing up. Alright, going live in a second.
Okay, wait.
Preparing to live stream.
Kira?
Pardon?
Rory, Clara can't hear anything. Oh my god.
It's okay now. It's okay.
Wait, try taking your headphones out, Clara.
There we go.
Oh my god. Wait, who's watching the video? I'm confused now. Okay, that's fine. So I've cancelled out of it. I think it's probably still streaming live, is it?
Guys, we are streaming live right now. Okay, Rory, you need to upload the slides.
Okay. Give me a second. How do you upload them again on Zoom? I just share screen, do I? With the slides.
Yeah. So Rory, you'll need to slide control.
Okay.
Or if you just keep an eye on the script, I think.
Hello everyone. Sorry, we're having some technical difficulties. We will be with you in a sec. Okay, hello everyone. Thank you for joining our webinar today, A Trend or the New Norm, an introduction to responsible investing. We would like to thank the Future Conference team for organizing this very interesting conference and giving us the opportunity to participate and talk to you guys about what we're really passionate. Great, so without further ado, let's get to it. Okay, we're going to start by introducing ourselves first. My name is Agiliki. I am the head of operations at Prospero Social Finance. I am a fourth-year economics student at the University of Edinburgh, and I enjoy dancing.
Hi, I'm Clara. I'm the Director of Strategic Relations at Prosper, and I'm a third-year politics student.
Hi, my name is Jay. I'm a chemical engineering student. I'm head of strategy at Prosper, and I enjoy playing golf.
Hi there. Finally, I'm Rory Sanderson. I'm the Director of Marketing at Prosper Social Finance. I'm a third-year economics with environmental studies student, and I like skiing and spending time in the mountains in general. So now you know us, we're going to start to tell you a little bit about Prosper Social Finance and what we do. Jay, if you don't mind navigating to the next slide. There we go, what we do. So normally I'd show you this video, but I think currently it might work. Jay, can you maybe try and click the link? Let's just see if this works through the various media platforms. It might. Right, I don't think that's going to work. So Jay, if you don't mind just pausing that.
Is it working or no?
No, I can't see it playing. Don't worry, I'll just give the general gist of the video. If you go to the next slide, please.
Okay.
Cool. So Prosper Social Finance. So essentially, we're the UK's first student-led socio-responsible investment fund. Now, if you have no background in finance or investment, those words might sound quite foreign to you. But what we actually do is quite simple. We're underpinned by our mission to deliver positive social change in Edinburgh through responsible student-led investments. Now, how we do this is essentially through money given to us by the university. We invest in companies that are traded on something you might have heard of called the stock market. And now we only invest in companies which we deem are socially responsible. So that's kind of the main thing that we do. But alongside that, we run an analyst training program, which allows us to train up students about investment and socially responsible investment, and essentially open the door to finance to people from all backgrounds. As some of you may know, finance is generally quite a stuffy kind of reputation, not a very good reputation. So we're kind of going to try and break down those barriers and make it more accepting and welcome. So Jay, if you move on to the next slide, please. One second, Jay. Can you hear me? Jay, there we go. Perfect. So that's kind of the basis of what we do. I'll go into more.
Apologies, my signal's not great.
That's all right. So everything that we do is underpinned by our values. And so you'll see our 5 values here: collaboration, innovation, integrity, positive social impact, and transparency. So as a community interested company, everything we do is underpinned by these values. And whether it's our investment decisions, our day-to-day running of the company, our training program, or more generally our investment philosophy, these core values are essential to all that we do. And by keeping these values in mind, it ensures that we stay true to both ourselves and to our overriding mission of delivering a positive social impact. Next slide, please. Cool. So I'll start to tell you a little bit more about what we do. So this little diagram here should explain it better than I can. So as I said, we run an investment portfolio, which essentially just means we have a sum of money invested in companies. And these companies specifically are what we deem as socially responsible. So we use an ESG criteria, which we'll talk about more later, but essentially to kind of vet out good companies versus bad companies, as well as using our core values to ensure that these companies align with them. So with the money given to us by the university, we invest it in these companies. And by investing it in them, essentially, we're kind of indirectly supporting what they do and ensuring that these companies can continue to have a positive impact on the world and wider community. On top of that, as you see below the orange part of the diagram, we say financing change. So that's, as I said, when we're supporting these companies that do good, we essentially allow them to prosper, pardon the pun. Now, with these companies, when we invest in them, we invest for normally 5 years. And at the end of 5 years, we hope that we've made money on this investment, because essentially the money we put in increases in value the longer the company is doing well. With the money we make from this investment, we look to give back to both charities and social enterprises within the Edinburgh community. And so to have a direct social impact. Now, we don't just give money to these charities and social enterprises. We look to foster a relationship with them and allow us to kind of really make our money go further by working with them and seeing how our expertise can help them and benefit their businesses. And finally, we challenge perceptions. We challenge perceptions of finance specifically, trying to kind of open the door to people from all ethnic, social, academic backgrounds, to make it a more welcoming and more creative space, because we believe that everyone has something to offer the finance industry. And if people can only kind of open that door and break down those walls, then they can make it a better and kind of more acceptable industry. So we do that through our analyst training program, which I mentioned, as well as our senior analyst program, which is the kind of the next step after the training program, as well as our blog and events, which we host throughout the semester. Next slide, please, Jay. So as I've constantly been saying, this term socially responsible investment. So what is socially responsible investment? Well, as you can see here, it's the act of choosing your investments on the basis of social good as well as financial gain. Now, how do you do this? So generally, investors look for companies that have a good record on ESG issues, that's environmental, social, and governance issues, as well as the fact these investors engage with their companies. If they have concerns about how they're treating their employees or their carbon footprint, then an active investor, i.e. a socially responsible investor, will speak to that company at shareholder meetings and ask them to kind of why they're doing it this way and stuff like that. And we believe as being active investors really allows us to kind of to make this change and to essentially make these companies more socially responsible. The history of socially responsible investing is actually comes from a religious background. It started with both Christian investment funds and Islamic investment funds, and since then has grown massively. If you go to the next slide, please, Jay. Yeah. So as we can see here, the whole socially responsible investment sector has just exploded in recent years. As you can see in the diagram on the left, Europe still leads the way in terms of socially responsible investment. with in 2012, it had $8.8 trillion of assets under management, or sorry, sustainable investments. But as you can see in 2018, they're still the leader, but the US has caught up with now $12 trillion. And other regions such as Japan, Canada, and Australia have all really increased in this area. And so this kind of growth in socially responsible investment is a mixture of both kind of people realizing that we need to kind of use our money to bring about good, but also people realizing that you can both have a positive impact without forgoing financial gains. Because originally people thought in order to have a positive impact, you had to miss out on the best investment opportunities, and you had to kind of vet the more sustainable, kind of less economically profitable industries. But now this seems to have changed. It's really led to an influx of investments within these areas. Okay, next slide, Joe, please. Yeah, so as you can see here, there's lots of different ways people can sustainably invest, and it has become a little bit of a tagline. And so what this diagram here shows is that there's essentially different levels of socially responsible investment. At the bottom is negative exclusionary screening, which obviously has the largest amount of assets under management. And that's essentially people just saying, we're not going to invest in the fossil fuels industry or the tobacco industry, which is great, but it's not exactly innovative or kind of really kind of pushing boundaries. The step 2 above that, you'll see ESG integration. That's kind of looking at environmental, social, and governance factors across all the companies. That's obviously a step in the right direction. And then kind of as we move up, you see positive best-in-class screening, which means investors are really looking for the best company in an industry in terms of these environmental, social, and governance factors. So from our perspective, we're really looking at this sort of sustainable themed investing and positive best-in-class screening when we're considering our investments. So although you'll see it looks like there's huge amounts of people kind of sustainably investing, socially responsible investing, actually you need to be careful about kind of how much they're kind of pushing this movement. Obviously we're looking to do the best we can, and so are looking to kind of impact the community and kind of conduct sustainability themed investing. Cool. Next slide, please, Jay. Cool. So back to kind of us and what we do, our investment strategy. So as I said, our mission is to deliver positive social change in Edinburgh through responsible student-led investments. And I don't know why that's just been cut off there. So our portfolio, which is essentially the money which we invest in these companies, we kind of have three main goals for this portfolio. So firstly, to have an indirect positive social impact. So to support these companies and help them in their mission to have a positive impact on society as a whole. As well as that, we have a minimum financial return of CPI. So that's consumer price index, i.e. inflation, plus 150 bips, which is 1.5%. I believe that's per year. And so not only are we looking to have this positive impact and to help these companies, we still too want to have financial gains from this activity. So essentially, we need these financial gains in order to support these local enterprises and charities in our communities. So that's the kind of other aspect of what we do. And finally, we're looking for growth-orientated long-term investments. So another thing that kind of sets us aside is the fact we're not looking to invest in a company for a matter of months or quarters. We really want to support them over the long term. We believe that the more investors do this, the more they'll support companies that are really innovating and coming up with solutions to the challenges we face. So that's a key part of our investment philosophy. Move next slide. So where do we invest? So currently we're limited to investing in Europe and North America. So on the slide here, you can see the London Stock Exchange, NASDAQ, New York Stock Exchange. So as I said before, we list in publicly traded companies. So hence why we're looking at companies listed on these stock exchanges. And there's obviously various other ones in Europe and elsewhere, but that's essentially where we invest. And this is largely because just accessibility, and also in terms of conducting our research, the regulations in these regions makes it a little bit easier and a little bit easier to understand where these companies stand on ESG issues. Cool, next slide, please. There we go. So our investment philosophy. So we are bottom-up investors, as you'll see, I think, on the next slide. So at the bottom is our core values. So we start looking at any company and ask whether they align with our core values, which you saw earlier. From there, assuming they do, we move on to our ESG criteria, which is obviously where we look as to how they interact with environmental, social, and governance aspects, and whether we believe they are socially responsible. Assuming they pass both of these steps, we then move on to the financial evaluation, kind of how healthy is this company in terms of the debt or kind of the margins they're running, and do we see a growth story there? Which obviously moves on to the next aspect, which is growth, which is when we start to look at the business as a whole and the market that they act in and the region, etc., and to see whether in 5 years' time, whether this is still going to be as good a company as it is just now. And then finally, we look at the portfolio as a whole, and ensure that we're not invested too heavily in one region or one industry. We want to be kind of evenly spread to ensure we're not exposed to too much risk. Next slide, please. Cool. So yeah, so our investment philosophy essentially goes hand in hand with our research process, which is what our analysts conduct when they're on our analyst training program. So as I said, we're bottom-up investors, which means we start looking at the nitty-gritty in terms of the core values and whether this company aligns, and then move upwards, ending in the macroeconomic phenomena, and to see kind of where this company fits into the global environment. So if we go to the next slide, we'll just run you through these steps. So yeah, so first of all, core values. So you'll recognize these little diagrams on the right. These are, of course, our core values. And this is largely qualitative research when we're considering these aspects. You're asking kind of, is it an innovative company, or do they act in a transparent manner with their reporting on various issues? And actually, this is arguably the most important part of our investment philosophy, because if a company doesn't pass this, it could be the most profitable, most amazing company, but if it doesn't pass the core values, then we won't look at it anymore. We won't consider investing in this company. So this essentially is hurdle one, if you will. Next slide, please. And then, as I said, we move on to stage two. Jay is going to talk to you more about ESG investing later. But essentially, we're considering these environmental, social, and governance factors, asking questions like, do they damage the environment, or are they being inclusive and diverse in their employment strategies? So these are hugely important, and essentially this is the second hurdle. So if a company doesn't pass here, then of course we'll chuck it aside. We won't look into its financials or growth story. Next slide. So stage three is the financial evaluation. As I said before, here we're looking at the overall health of the company. Are they running a lot of debt? Is that going to be a problem if we go into a market downturn? Do they have kind of huge unsustainable margins, or are they kind of growing these margins in a sustainable fashion from year to year? So there's various different metrics we look at here, but essentially we just try and gain an overall perspective of the financial health of the company. Moving on, we have the business and industry analysis, which, as I said, is kind of looking at where that company sits within its industry and its region, and whether it's a growing industry, is it set to capture more of that market share, or is it hugely competitive, and is it going to be beaten by its kind of bigger neighbor? So this is a more kind of qualitative analysis, but is really interesting understanding the future of that company. And then finally, we've got stage 5, which is the macroeconomic analysis. This stuff is less specific to the company because we're considering these kind of global phenomena, but we do consider how these phenomena are going to impact the company as a whole, be it kind of exchange rates or political events, etc. So that's essentially is our investment process, our research process, and it kind of leads us when we're looking into companies. So I'll now pass on to Jay to talk about ESG versus CSR.
Thanks, Rory. So yeah, we're going to start off by, bear with me, looking at what E, S, and G are for Prospero. So as we know, ESG stands for environmental, social, and governance. Now, it can be a bit of a buzzword, as Rory said earlier. So I want to break it down a little bit as to what we perceive it as and how does Prospero use it. So Prospero aims to break it down into measurable metrics that we can look for information about from online sources. So these ESG factors or metrics that we use, we want to see embedded in companies' business operating model. For us as investors, we see this as essential. And as Rory said, it's the stage 2 of our investment process. If companies fail this, we won't even look further. So we'll start with the environment. So many companies have put their environmental goals on hold as a result of the pandemic. So one of the things we'd be looking for is a continuation of their environmental goals and achieving these performance targets. So we focus on a variety of metrics. The key ones for us are looking at operational and carbon emissions, product carbon emissions, water consumption, and land usage, for example. And importantly, also looking at their sustainability plans. What are they working on to reach net zero emissions or improve their process efficiencies? For social, we focus on the supply chain and social impact of their products. We also consider product safety and quality here. And we have a look at the company's key suppliers. Are there fair contracts and ethical labor standards within their supply chain? It's about getting diligence. It's about doing the diligence to answer these questions. With governance, we're particularly interested in corporate governance, human capital. So that's how they treat their employees, opportunity for development and management, and equality. So we'd examine this by looking at the executive leadership diversity. So how many men and women are in the executive board, specifically in relation to other companies as well as a benchmark we would compare them to. And we also like to check whether their executive leadership adhere to best governance practices, how are they treating their employees, is there a gender pay gap? So these are the kind of metrics that we're looking for. So for Prospero, by embedding these ESG factors and issues into the business model, not only is this aligning with our core values and philosophy, but in our opinion, which is backed by evidence, which Clara's going to describe in a minute, these companies, which are more environmentally sustainable, socially conscious, and are striving towards equality, are much more operationally resilient. So they're better prepared for catastrophes and crises like the pandemic that we've just had, that is ongoing. And this embedding of ESG will allow them to recover and respond much more quickly. Now, I'm going to just switch it up a little bit, and we're going to look at the difference between ESG and CSR. So CSR stands for corporate social responsibility. So by definition, it represents a company's efforts to have a positive impact on its surroundings, its employees, its consumers, and the wider community. CSR strengthens the bond between employees and organizations. It boosts morale of employees and makes employees feel more connected to reality. Typical programs include direct giving, so giving a bunch of money to a charity, philanthropy, and volunteer efforts that can benefit society while boosting their brand. But the problem with CSR sometimes, or most of the time really, is it's done for brand and marketing purposes. It raises consumers and customers' awareness of the brand, and CSR helps to portray them in a positive light, that they really are doing good for the community. The challenge is any company can perform CSR. They can produce a volunteering program that their employees can be part of, or give monthly donations to a charity that they want to. This means they don't actually have to address operational issues within their business. So for example, ExxonMobil in 2018 contributed $211 million to communities around the world, which includes donations from ExxonMobil Corporation and their charity foundation. For context, ExxonMobil had earnings after income tax of $14 billion. So by percentage, they donated 1.5% of their income to charitable causes. Fundamentally, ExxonMobil are an oil and gas company. And I know a large amount of crude oil is still used for medicines and things like that, but a significant proportion, around 45% of a crude oil from a barrel, goes to energy generation and transportation. And so fundamentally, we feel like ExxonMobil need to address issues within their business. Now, looking at the difference here with ESG is its precise measurements of companies' actions with regard to these metrics. Many traditional investors are now employing these strategies because it helps them understand less quantifiable risks of the firms in which they want to invest in, such as corruption, climate, and political risk. The primary difference between CSR and ESG is that CSR is an internal function, while ESG is an external one. So CSR programs are internally proposed and executed. Companies can choose who they want to donate to, and they can choose the metrics through which they can measure their performance by. ESG, on the other hand, is a measurement that analysts and regulators can use to objectively compare the effectiveness of different corporate efforts to address these issues. Now, what is Prosper's view on it? So although they are similar in meaning and intended direction, CSR is often just added into business strategy to support brand awareness, and it's not really part of the operating model. CSR can also be a green and social washing mechanism. So green and social washing is a concept where companies try to convey a false impression or provide misleading information about how a company's products are more environmentally or socially sound. So CSR can make companies appear much more socially conscious than they really are. Instead of really addressing any ESG related issues, they distract you through surface level deeds. So a prime example again is ExxonMobil. ExxonMobil have some renewable energy programs that they're focusing on in their research and development teams and their R&D side. One is turning algae into biogas, which could be a renewable fuel for the future. And the second one is focusing on carbon capture from fossil fuel plants. In a commercial in 2016, they had 19 employees at the Olympics like commercials. They had a commercial which had 19 employees, 12 women and 7 men. At the time, Exxon's management team, the exec management team was 100% male. So this is like a prime example through marketing where they've done green and social washing. They've highlighted that small, minimal positive environmental impact that they have, when in actual fact, ExxonMobil are an oil and gas company focused on exploration, extraction, and refining. And so from an environmental perspective, fundamentally, they are not a very sustainable organization. They try to divert your attention from the smoke leaving the chimney, as described in the image, by painting the chimney itself green, while allowing that smoke to continually be emitted. And so through CSR, it's a mechanism through which greenwashing can happen. And so Prosper feels that embedding ESG factors into the operating model and the supply chain within as many facets of the business as possible will lead to much more sustainable and controllable growth, more productive workforces, and much better risk management. Now Clara is going to talk about kind of the effects of COVID-19 and the developments in the world of finance.
Great, thanks Jay. As he said, I'm going to just speak about what COVID-19 pandemic has done for the world of socially responsible investing. The COVID-19 pandemic has brought a lot of political and economic social distress to the world. I'm sure many of you have been keeping track, but just as a reminder, so far there have been over 18 million confirmed cases and more than 600,000 deaths. Whilst we can't actually understand such numbers, needless to say, this pandemic will go down as a monumental event in history. Within the first months of the pandemic, major players in the world of finance were highlighting the importance of ESG investing in building better after the pandemic. Please, if you're able to read and listen to someone speak, take the time to read through these quotes. In essence, what finance executives say is that the pandemic has acted as a wake-up call and reminded us that we have to think of others, not just ourselves. This is in line with the general movement to build better after the pandemic. Apart from this reminder of compassion and altruism, which some of you may think has no place in the world of finance, the pandemic has highlighted the immense economic and financial consequences posed by high risk and high impact events. May I also remind you that within this category of highly catastrophic and quite probable events lie environmental disasters, such as drastic loss of biodiversity and destruction of the ozone layer. At this rate, these are both becoming increasingly probable. Next slide, please. So in light of these two realizations, there's arguably been a shift in perceptions and priorities in the world of finance. According to a study by Morningstar, within Q1 alone, which includes March, globally the most economically detrimental month of the pandemic, sustainable funds in the US set a new record of flows. This is also shown graphically in the image below. Simply look at the difference between the green column to the far right compared to the one right next to it. Globally, there are net outflows to the sustainable funds, which amass to $45.6 billion, compared to net outflows of $384.7 billion in the overall fund universe. Next slide. Now, this shift towards socially responsible investing is not without realized benefits. The most important achievement in the world of ESG and socially responsible investing is that such funds consistently outperform their counterparts. In fact, globally, assets in ESG-focused funds outperform their counterparts. ESG-focused funds were down 12% in March, compared to 18%. To give you some specific examples, the Nuveen Large Cap Growth Exchange Traded Fund has returned 10% this year. By comparison, the S&P 500 is down roughly 1% for the year. Next slide. To further highlight the performance of socially responsible funds, and namely ESG funds, I've included this graph which compares the performance of ESG versus non-ESG funds by region. The orange line represents the FTSE 100 index in the UK, and the blue line represents the MSCI ESG European index. As depicted in the graph, both funds faced a major fall in March of 2020. But may I point out that the MSCI ESG fund did not fall as much as the FTSE 100, and in fact, since May, is significantly outperforming it. Next slide. So how about Prosper's fund? Since Prosper's inception in June 2018, Prosper's portfolio is up 21%. In January of this year, Prosper's portfolio was up 13.10%. A small portfolio like ours has done comparatively well compared to other indices. Since June 2018, the S&P 500's return is 19%. In January 1st, this figure was 18%. Whilst the S&P 500 has only a 2 percentage point difference in return compared to Prosper's as of today, the return of our portfolio has increased by 8 percentage points since the beginning of the COVID-19 pandemic. Now, I may be biased, but that's pretty impressive for a small fund like ours. Moving on. Oh, sorry, Jay. Now that I've bombarded you with facts and figures, let's go back to the question I posed in the beginning. Why are we here today? And the answer is simple. The COVID-19 pandemic has reminded the world of finance to be more compassionate, but also reminded it that high risk, high probability events like pandemics and environmental disasters can have catastrophic economic consequences. That's it from me.
Great. So now let's move to an ESG related quiz. Unfortunately, we couldn't make it interactive for you to participate live, but that's okay. I'm just going to present the questions, leave 10 to 20 seconds for you to answer, and then I'm going to present the answers. So, oh yeah, and of course, it's okay if you don't know some of the answers. This is more like a fun fact kind of thing. Great, so let's move to the first question. When was the term ESG used for the first time? 1990, 1960, or 2005 or 2015? Right, so the correct answer is, if we move on to the next slide, 2005. And in fact, the term was used in a landmark study called Who Cares Wins. Great, so moving on to the next question. Which of the following do not fall under the category of social under ESG? A, human rights, B, child and forced labor, C, health and safety, D, transparency and disclosure, or E, employee relations. Right, so the correct answer is D, transparency and disclosure. And yeah, transparency and disclosure does not fall under the category social. It falls under governance. Moving on to the next question. By how much did the amount of US assets under management invested in ESG portfolios grow over the past 2 years? By 5%, 10%, 30, or 90%? And the right answer is C, 30%. And actually, ESG managed assets are expected to make up half of all managed assets in the United States by 2050. And the next question is, which of the following is not true about ESG, SRI, and CSR? So Jay talked about this earlier on in the presentation. A, in CSR, you strictly include or exclude companies based on ESG criteria. B, CSR measures a company's activities to reach a precise assessment of its actions. C, ESG is meant to be part of a broad range of criteria. Or D, all of the above. And the correct answer is B. So statement B is false. As Jay explained earlier on, CSR represents a company's efforts to show that they have a positive social impact, but mainly for marketing purposes. So that's the key which distinguishes CSR from ESG and SRI. And of course, statements A and C are correct, since ESG is a range of criteria and metrics that we use to conduct socially responsible investing. And the next question is, the process of conveying a false impression or providing misleading information about how a company is environmentally friendly is called A, CSR, B, ESG, C, greenwashing, or D, impact investing. And the correct answer is greenwashing, of course. So greenwashing is related to CSR in a sense that CSR can act as a greenwashing mechanism. However, the difference between the two is that greenwashing explicitly involves the concept of deception about how the company is environmentally friendly, even though it is not. So moving on to the next question. Which industry comes second as the world's largest polluter after energy? A, production, including the fashion industry. B, transportation. C, agriculture. Or D, forestry and land management. Okay, and the correct answer is B, transportation. In fact, transportation and energy go hand in hand, and transportation makes up for 28% of total greenhouse gas emissions. Okay, and the next question is, how many garments does the fast fashion industry produce annually? Is it 5 million, 17 million, 200 million, or 1 billion garments? And the correct answer is 1 billion, unfortunately. So you might know that fast fashion is one of the most destructive industries globally, emitting over 1.2 billion tons of greenhouse gases annually. And question 8, the kind of extremely hot zones, like in the Sahara, that now cover less than 1% of the Earth's land surface, but 2070 they could cover nearly 5%, 10%, 20, or 50% of the Earth's land surface. And the correct answer is 20%. So this prediction highlights the severity of the climate crisis, as it is expected that in 50 years, just in 50 years from now, 20% of the Earth's land surface is basically going to be uninhabitable. And unfortunately, this problem is actually evident from now, as we can see from the next question. In Southeast Asia, increasingly unpredictable monsoon rainfall and drought have made farming more difficult. As a result of this, more than how many people have moved towards the Middle East, Europe, and North America? Is it 800,000, 2 million, 5.6 million, or 8 million? And the correct answer is 8 million, which again depicts the devastating situation of the climate crisis and subsequently the problem of climate migration as a result of this. So the last question is, companies with high racial and ethnic diversity among their employees outperformed their counterpart companies by 2.3%, 5%, 20, or 35%. And the correct answer is 35%. Right. So this was the end of the quiz. Now we are going to proceed to a short Q&A session. You can ask anything that we've covered over this webinar about ESG, SRI, or anything related to Prospero and what we do. You can post your questions on the YouTube live chat. So we are going to wait for a couple of minutes to see if we have any questions. Okay, great. So this was the end of our webinar. We hope that you found it interesting and that you learned something about ESG and socially responsible investing. Thank you to everyone who joined us today. And again, a massive thank you to the Future Conference and its organizers. That's it from us.
Thanks very much for tuning into this webinar, guys. If you want to find out more about Prosper, check out prospersocialfinance.co.uk, and our Facebook is Prosper Social Finance. So make sure to just check us out. Cheers. Thanks.